What's up, Mark? How's everybody doing this morning? All right, man. I was up late last night. I'm tired as heck. Anyway, all right. Well, we got a good live stream coming up today. I just wanted to say hi to all the people that's here, meaning Mark. And we've already been talking in Discord. So, oh, man. I am so tired. I'm going to go for the biggest nap. I slept from like 12 to 2. And then I woke up and was up from like 2 to 5:30. Then I fell back asleep from like 5:30, 6:30. Just enough sleep to make it even worse. Oh my gosh. I feel like I've been up all night cramming for finals. All right, but no, I'm excited about this show, and I think hopefully I'll have something intelligent to add. We'll see. It's anyone's guess. All right, so let's go over and check in on Mr. Ambassador, our friend Mr. Kwan, the Ambassador of Kwan. He usually plays a little AI intro music. So I figured if there was more than just one person here, we might shoot the breeze for a second and skip the AI intro, but the AI music intro. But no disrespect to AI. But it's not my deal. All right. Well, I guess we'll check it out. Let's see. Oh, shoot. Notifications. Just a second. I want to see if I made some kind of bad comments yesterday. I want to make sure I want to see if I got any. I got blocked once yesterday. I don't think anyone. I think I'm fine. All right. Well, let's go. I guess let's go check this out. Oh, I need to remember to share the audio with you guys also, so I will remember to do that. Am I sharing the screen even? I'm not, of course. I am. Wow. All right. Well, hang on. I need to get the audio shared. All right. I'm beat. Good episode of Bill Maher last night. I love Bill Maher. He had Marjorie Taylor Greene on. I enjoyed it. It was a good episode. All right, let's go see what they're doing. Where the heck is it? Yeah, that's my creed, but it's grace that gives us ground beneath my feet. Mercy knew the fight's not done. I rise again. She's not there.
All right, I hope you guys like that. If you wake up in the morning, let me know. I appreciate the feedback. I hope that y'all are having a great morning. It's beautiful Saturday. Got some special folks here. Going to go invite Max on up. Appreciate you all for showing up this morning and taking some of your time and treasure to get educated, to learn more, and be able to make great decisions for yourself. Let me go through this. First and foremost, I just want to say thank you to Howard for coming in this morning. He's a West Coaster, which means it is like before coffee o'clock. Howard, thank you so much for popping in today. How are you?
I'm doing well. Thanks for everybody for joining. Thanks for inviting me to be here. It is very early, but I'm excited.
Well, we're excited to have you. We're so grateful, and in such a time as this, where an individual like yourself who is spinning up these ETFs, who is looking out for the retail traders and making sure that we have great options, to come in and spend time with just a guy like me and our panel and share with the community. We just feel so very blessed, and words fall short of being able to say thank you so much. It looks like you had a nice opening. I couldn't see exact numbers, but it was definitely over $2 million cash inflow. Is that right?
Just shy of that. Yeah, about we had 4 creates since we launched. So that's thank you for everybody. Everybody's on here. I guess didn't go out for Halloween yesterday.
Yeah. All right, we're going to get started. Howard, please, you don't need to ask to speak. Anytime we're saying anything, you want to pop in and give some clarifications or make sure that we know what's going on. Please just unmute yourself and go ahead. But I want to go around the panel and make sure everybody's doing well. ETF Delta, how was your Halloween? And thanks for being here this morning and all the work you're doing to prepare.
Yeah, good morning. Rainy and cold on the East Coast, but good Halloween nonetheless, and excited here to talk about all the exciting news from yesterday with both of these ETFs finally coming online and some competition heating up.
Yeah, it's definitely nice to have menu selections and allow meritocracy to live. ETF Inspector, how was Halloween with the kiddos yesterday?
Hey, good morning. Not bad. We live on a little street out in the woods, so it's pretty quick for us, just down and back, and I got to be done. They went over to a friend's neighborhood to go extend their collecting, and then I got to teach them why we don't like taxes.
Nice. Yeah, I live somewhat out in the woods here, but we have a neighborhood, sort of, so to speak, here. We live on a cul-de-sac, so it was amazing. You'd see trucks pull up with flatbeds in the back, and the flatbeds would have like 20 or 30 people kind of sitting on them. They'd all jump off and then run around the neighborhood. It was a lot of fun. Had a good time. Max, how was Austin? Everybody good and settled there for Halloween?
Yeah, everything's going well. I didn't have any. I went and got some candy, and no one ended up showing up. And I was just griping to the guys in my Discord that I couldn't sleep well last night. But I remember I ate a bunch of freaking candy, right before bed. So it probably, I'm paying for it today. Let's just say that.
All right. So what I wanted to do is go ahead and welcome everybody officially to our space. Thank you for joining so much. The purpose of today's space is to kind of go over the 2 ETFs that were spun up yesterday. One from Curve, that's ticker KYLD, and one from Rex Shares, and that's ULTI. But before we jump in, a quick reminder, everything we discussed today is for educational purposes only. None of us are providing personalized investment advice, and investing always involves risk. Please do your own due diligence and seek professional guidance before making any financial decisions. So with that, I just wanted to say over the past few years, the income generating ETF space has really transformed. As recently as in 2018, we only had about 10 derivative income ETFs. That's because the rules changed and they allowed it to come to market. But since then, we have grown from 1 billion AUM in these kinds of funds to over 100 billion in these kinds of funds. And I am not shy to say, I think a lot of that came from retail investors like the folks here listening in the panel. In parallel, the market has seen hundreds of new actively managed ETFs launch in recent years, over 900 of them in the past 12 months alone. So as you can see, it has expanded dramatically. There's a lot of excitement, but there's also a lot of confusion because they've spun up, lots of them going with different kind of derivative actions, different strategies, different ways of making income. And all this means one thing: increased opportunity, but also, I just can't say this enough, increased responsibility for you as the individual investor. You're trading your most precious asset, time. Most of you have swapped time for fiat currency, which you've then invested in these. So you have given up time and treasure to be able to do this. It is so important and so imperative that you all understand what you're getting into, make good choices for you and your loved ones. And that's kind of why we do this. We do this to make sure that you have the best opportunity to be able to make good choices for yourself and your loved ones, and then put your fiat money that you've traded time for to work. So today we're going to go over the tickers. We were going to start with Max and ULTI, but since Howard has been so gracious enough to give up precious sleep to pop in here, I thought we'd let him go first and just kind of introduce his fund, tell us how it went, and any highlights before we get ETF Inspector to get into the nitty gritties, and then Howard can comment on any of the trades and items that ETF Inspector wants to talk about. I hope that's okay with everybody. Howard, you have the stage and the floor.
Okay. Well, first of all, thanks again for everyone who, at least, when we posted the launch of the fund, it was one of the most viewed posts that we have, and this has actually been the first day trading shares of the of an ETF that we launched at the highest. I think 84,000 shares was traded on the first day. So, thanks for everybody who contributed to that. Um, we filed this actually a while ago because um, this is our 10th ETF, and for those who have followed us for a while now, knows that we're actually very particular. I know on the Twitter sphere, I guess X sphere now, people are starting to put together league tables and compare with us with other offerings, etc., which is fine. But we've always kind of managed our ETFs in our own way, and um, what we want to do is deliver a consistent return, consistent distribution uh, with some price appreciation. If you look at all of our strategies, we list them all at $25. Every one of them is close to $25, if not above that, very much above that. The one that's, I think Apple is like 24.85. That's because we just did a distribution. So hopefully now, I think 2.5 years in, people kind of see our style and know that there's a particular way that we manage our ETFs. So K yield is no different. It is the most, I would say, unconstrained version of what we do. The last most unconstrained version is K triple Q. It does take us a while to get to, I would say, cruising speed on our strategy. When we first launched K triple Q, or I should actually say, Curve Tech Titan strategy, uh, we spent some time to get nav stability, and then once we've hit that, the strategy really have worked out. And for that particular strategy, the distribution is about 18%, and it's outperforming triple Q, right? So that's our goal. There isn't a benchmark per se for this one, but our goal is to have, this is in its name, high income, but we also want nav stability. So the way that we think about the strategy is that, in the tech titans, we're constrained to companies that are related to technology. This one is unconstrained. So we look in the universe of things that we think, and these are the various different components that we think about. Is first, we look for names that have very high implied volatility, but not the highest, because sometimes when you have the highest, it doesn't have any liquidity. That's that's an issue. So we avoid things that don't have liquidity because there's wide bid ask spreads. Those costs ultimately get passed down to the investor. So we don't want those. Then we look at names in which we think there's high growth potential. Dominique Turson, myself, Dominique's the PM. We look for names that where we think there's some sort of catalyst in order to generate high growth and high earnings. We don't just buy anything that um, the market says. It also has to be a business that we can understand how they generate their earnings. So you'll see in our portfolios names that I think are easier maybe to understand because there's sort of an investment thesis. And largely, they have to have already been generating earnings already. There's a few exceptions. I'll kind of explain why. And so that's how we really construct the portfolio. And lastly, is that this fund will be a lot more tactical than a lot of our other funds. So I'll kind of maybe go into each one of these details so you can understand the style. For us, the most important thing is not necessarily to beat a competitor. There there are definitely other names that could go up 100, but if we don't understand it, or if it can go up 100% but go down 100%, we also try to avoid those because for nav stability reasons, right? um, so that's the style that we run. We want to generate, the goal is we want to generate high income, consistent, and have nav stability. So going into launching the ETF, this is sort of like backstage stuff. We actually we wanted to launch in October. We ended up, the timing was sort of last 2 days of October, which is an odd time to launch this because this last week was all of earnings. So we wanted to avoid certain things. So again, if the earnings are terrible, that does not lead to uh, uh, um, NAV stability. But we do want to take certain opportunities. All right. So right now in the portfolio, largely from a construction perspective, there's 5 themes that that's in the portfolio. The first is a sort of a second derivative to a debasement trade. So as you guys know, gold and silver has been going up a lot, right? Fear of government shutdown, or fiat debasement, etc. So gold has gone up now a little bit less than $4,000 per ounce, but um, what we view is that this is actually in the short term extremely good for mining companies, because what they've extracted out of the ground was much less than that, and then the market, their products that they're selling is much higher than that. So for at least for the next quarter or two, they're going to have extremely good earnings. So that's sort of what we call the precious metal theme that's happening in the market. The second one is we have the same theme in Tech Titans, which is the AI infrastructure. We continue to believe, although it's starting to get a little frothy, there is going to be the demand for AI is outstrips the supply, specifically in the infrastructure space. So that is typically the cloud providers, the chip makers, or the real estate play, which is the data centers, right? So you can see in the portfolio names like Broadcom, AMD, Teradyne, Vistra. That's all within that particular name. Now here, I want to make a contrast between here and Tech Titans. In Tech Titans, you can see we have some of the similar names, but we have bigger names like Microsoft, Nvidia, right? Those are what I call core, right? But in this fund, what we want to look for high growth. So these are actually the smaller names because if they're able to make contracts and catch up with Nvidia, they have a higher growth potential than Nvidia. So see, this is the difference between this strategy and Tech Titans because we're looking for higher growth opportunities, right? So that's a component of this. The third thing we have is part of a debasement trade, but largely just from a crypto Web3 perspective. We think that it's going to still continue to grow. So you'll see names like Galaxy, Coinbase. We love when we have rails, rail business. So, you're not hauling things, but you're part of the rails. You're taking a profit from everybody who's traveling on top of the rail, right? Like the App Store. Those are businesses we like. So you see Coinbase, Bitmine, even the Bitcoin ETF. Okay, that's in the portfolio. All right. I'll describe to you. Most of these holdings are in securities, but that particular one we did it synthetically. I'll explain a little bit why later. The fourth theme is sort of, I would say, kind of defense or government supported companies. So you can see that in Helmet and BWX. There's one name, Intel in particular, is sort of the cross between different themes. it got invested by the government, and it's sort of an AI infrastructure play. So that one has particularly done well, and we actually think it's going to continue to do well because I don't think at this point the government's put in a lot of money in it. It's probably not going to let it fail, right? And then the last one is what we call companies that have network effects. So these are the Reddits, the Robinhood. That's also sort of a Rails company. Shopify, another Rails company, right? If you want to sell things online, you don't want to have a brick and mortar store. Shopify is where you go, right? Roblox, app loving, and etc. So those are the 5 core themes that is in the portfolio. Okay. Now, because we were launching this ETF near earnings, we actually did not write a lot of options on names that were announcing earnings because we wanted to wait for earnings. If it was below expectation and it fell, generally implied vol would go up. That's when we would maybe write more options. So you'll see probably next week the portfolio will change or have more positions because we're now a little bit over earnings seasons. So where we're starting day one, actually today's day two, Friday's day two, is going to change a little bit. Yeah. Now, I mentioned 2 things that is a little bit particular to this portfolio, which is uh, we're going to be more tactical, and we did a synthetic on Bitcoin. All right. So if you take a look at Friday's holdings, there is a call on Amazon. Uh, that's actually already gone from the portfolio. The reason we did that was because earnings was on Thursday night, and we seeded the fund, Thursday. So we had to make decision to make, and given what we've seen with the company, and again we think again the demand from all of the other companies that have reported, we believe that this was going to be a really good earnings for Amazon. But Amazon's a core name, right? It's in tech titans. Amazon's probably not going to grow 200%, right? So for us, that was a tactical positioning. So we wrote a call because we think earnings was going up. So you know, we um, we're going to take advantage of the price appreciation that could happen after earnings. Fortunately, we were right. Amazon was up 10% after earnings, and you'll see that had contributed to portfolio performance on Friday. The last bit of piece that I want to mention is the synthetic on a Bitcoin ETF IBIT. So most of all of these so far that I've mentioned are all securities, right? And then we will do sort of option strategies on top of the securities. The one thing that we did it via synthetic is the IBIT ETF. And the reason for this is because we're thinking about taxes at the same time. So, for those who are more familiar with structures of ETFs, there's actually 2 types of legal structures for ETFs. There's a 40 Act ETF, which is what K Yield is, and then there's a 33 Act ETF, what they call a grantor trust. The, these ETFs are used to hold things that are not securities. So if you look at gold ETFs, silver ETFs, all of the Bitcoin ETFs, they Bitcoin, gold, they're not securities. All right. So in order to hold them, they put them in a 33 Act ETFs. Both not basically non-securities. So this includes if you hold gold or Bitcoin or these grantor ETFs, they spin out what IRS considers bad income because they're not considered securities. However, options on these ETFs are considered securities. So securities generate good income, which means you get capital gains. Bad income, you're taxed whether it's realized or unrealized, etc. So we want to generate good income for the portfolio. So that's why for IBIT, we did it through synthetic. So that means it's a long call, short put of the same strike, and that gives you the economic exposure of owning the ETF. Except now, because options on these ETFs are considered securities, these will generate good income instead of bad income if we held the ETF itself. So I'll hold there. I've been speaking a lot, but uh, happy to answer any questions.
That was perfect. I couldn't have scripted that better. I thank you. I'm going to turn the floor over to ETF Inspector because he was going to be looking at KYLD. I'm sure he has a few questions, and we can go from there and see how it is. Also, I want to say anybody in the audience that has a question, Howard is here. ETF Inspector has broken it down granularly. Please hit that little button, either ask a question or raise your hand and come up on the stage. ETF Inspector, it is all yours right now.
Thank you, Ambassador. And thank you, Howard, for the explanation. So you actually did a better job than I would have done kind of introducing the fund, and you spoke to what's in it. So I'm going to kind of switch over and more just ask a couple questions rather than go back through and talk about what's in it since you already did. So right off the bat, have you guys picked what I'm sure you have, but have you announced what is going to be announcement day, X day, and dividend payday?
Yeah, we did pick a date internally. We haven't announced it because it want to make sure the portfolio is stable. Right now, we're targeting the second week of November. So declaration will be, we usually declare on Tuesday, but November 11th, Veterans Day. So we'll declare that Monday, and then Tuesday holiday, and then Wednesday is the record date, and then we usually do the payment date on the Thursday.
Okay, and then going forward, since whenever there's not a holiday, it'll be a Tuesday, Wednesday, Thursday.
Yeah, yeah, yeah.
Okay. And now will it be based off of the previous week's performance, or will there be a delay?
So that's the why. That's the reason why we haven't, because we wanted to see what's the implied vol jumps around, right? Especially for these higher vol names. So we wanted to see what premiums that we get. Usually, it will be as I know it's a bit of controversial topic in the community. Um, we don't want to have NAV erosion, so we will look at what premiums we get, most likely the previous week, and then make a decision whether that level of implied vol is normal to the market. If it's higher, we might keep some of the implied vol premiums that we harvest into the fund, so we have a what we call it an internal bank. If it's shorter than what we usually get, then we will use up the bank so we can smooth out what the income distribution will have from the fund.
Okay, so that kind of leads into my next question. I was going to ask, do you have like a target yield you're trying to pay out, kind of so people know what to expect, or is it going to move with volatility?
We will, because of the bank, we'll try to smooth it out. I, I, I will say, um, this fund will have higher. Okay, this is actually something I want to set expectations for people who are interested in the strategy. Is that I believe right now in our internal calculation, the first distribution annualized will probably be higher than any of our funds that we've launched so far, but it will be below what the long term rate is because we want to step into this cautiously. So where we come out with will not be what the final number is. It will be probably lower than what the final number is. Um, we don't. That I think is one of the things that we are a little bit different is we don't target a rate because this is actually where the problem is with a lot of NAV erosion, right? So if your target, say, a number like 30, and the market doesn't give you 30, then you have to return some principal to the investors. And that's where the NAV erosion happens. So, I want to give you an example, right? So you want to distribute 30, 35, right? And the market gives you 30. This is why we have the internal bank. So if we have premium that's in the internal bank, we'll use it to get to 35. But if we don't, we'll just do 30 because we don't want to get into a situation where we give back principal from the fund. If that makes sense.
Yes, that makes a lot of sense. But there's gonna be weeks. I mean, there's gonna be weeks where, let's say, you lose your trades, and generally that is gonna overall not be the end of the world because that means that the share price ran beyond your call strike price and the value of all your shares went up. So in those weeks, you're going to lose money realized in the trades, but
Yeah.
overall your value is going to increase. So you'll take that into account. And let's say you don't have a bank yet. Let's say, or the bank's just not going to be enough. But since your NAV has increased, then you'd feel comfortable. Call it return of capital, as long as you're staying above or real close to that $25 mark.
Yeah. So you'll see. What you'll see is this. You'll see we'll distribute an attractive yield because it will be higher than any of our existing ETFs. And then we allow the NAV to go up.
Howard,
And
could you since you're referencing it, just for the people that may not know some of you other, what is the highest yield of any of your other ETFs? So when you say higher than, we at least have an idea of where that might be.
yeah, I think the highest distributing ETF that we have is Tesla, and that's gone up like 20 in the past. The highest 28%. So it'll be higher than that.
Thank you. I'm sorry to have interrupt. Please go ahead. I apologize, but thank you for that information.
Yeah. Um. So you'll see this. KQQ is pretty instructive about this, which is that um, the NAV will rise and the distribution will be um, it will be higher than Tech Titans, but we were for that particular fund with the implied vol, we were at like 12-15% for a while, and then NAV reached a certain amount in which we don't think there's going to be further NAV erosion, and now it's up to 18 a 19% distribution. So there was a jump once the internal threshold has been reached. This fund will probably reach that faster. So um, um, that's the way we do it because we don't want to erode. So yeah.
Okay, that makes sense. It sounds like you're speaking to a large portion of the community because we hear a lot where even if people are getting good total returns, if they see their share price dropping, they're getting upset and they're calling names and jumping out. So it looks like
Yeah,
that's kind of your target.
I know like some folks this is and actually if people can um, provide feedback also this actually be great, right? The concept of total return is great, I think, because you have an apples to apples comparison of the performance of an ETF, right? But my understanding is if you're using these products, you're an income investor, you're using some of the income, right? Or else you would rather not, you would rather have an ETF that never distributes and just reinvests the whole time, right? If you're not using income, right? Total return is a calculation that assumes you reinvest 100% of your distribution back into the fund, right? So if that's the assumption, then um, you should be in a non-distributing ETF because then you don't even have to worry about the reinvesting the income, right? I feel that if you're an income investor, you are receiving some income And then there's some really fancy reinvestment programs where you don't reinvest back into the same ETF. You go into other ETFs. That's actually a pretty genius thing. But um, you're taking some of the income, so that means you're not reinvesting 100%. So you don't actually get the full total return, which means that if you're getting your principal back, that's actually not a desirable thing if you're an income investor, right? Because um, you know, you if you give me $100, I make $10, and you're using it for living off of it or reinvesting out of it. You want to reinvest the $10, right? If I give you $20 back, you're actually reinvesting $10 I've made and $10 of your own money back into other funds. So the way we think about it is just that if we are able to keep NAV stable, anything we distribute is the money that we made, not the money that you gave us. That's how we're thinking about it.
Okay. No, thank you for that explanation. So I'm gonna just have like one more kind of question or group of questions, and then I'll kind of turn it over because I don't want to dominate this. So I would say, can we expect to see options trading on each of the underlyings?
Yes, and
Okay.
maybe indices. And that's actually a good question. So I saw some maybe postings about how our perspectives is a little bit complicated. The, it's actually the same perspectives as tech titans. If you look at it, it's actually a lot of the same language. And the reason is because for these names, different strategies applies at different times. For instance, in the Amazon example, we just wanted upside. We wanted, if earnings was great, we wanted to carry the upside. So we just wrote a call, right? We didn't do a short put to get a synthetic. We just did a call, right? I will say in some names where earnings were great, but for some reason the market punished them in share price. Those are perfect examples for put spreads, things like that, right? So we generally in our strategies we put in flexibility to address different market environments, but that doesn't mean we use all of the discretion we're given, which is a very strange thing to say because you know I guess I'll say so we have self control. We look to apply the right or the more suitable option strategies for the particular name that's in there. The one thing I did not mention, and I think people who are interested in a strategy should know, is that one thing that we do have in the prospectus is to buy protective put. Um, we will, for NAV stability purposes, if we think um, market is going to fall, which we do think market is a little frothy, we will sacrifice, say, a little bit of income to mitigate downside. Like, 1% of, if we sacrifice 1% of the premium, we can mitigate 8% downside. We will do that, right? So we're not just focused on just income. So that's something that I think will also makes us a little bit different is that we want to give good income, but we also want to preserve, your capital in the strategy. So that's something I think just people should be aware of. At times we may not be the highest yield because we're using that to um, buy protective. You can see in Tech Titans right now, we have protective puts on right now in that strategy because we think um, we've had a good run. Earning season's over. Sometimes there's a pullback, so we want to protect capital. So again, that's another application of option strategies in the appropriate time and risk environment that strategy's in. So
Okay. So just the follow up on the option question is basically this doesn't really fall into one category where a lot of funds might be called a covered call income strategy. This seems like this is if we invest in this, this is going. I believe that Howard and company are good overall traders and stock pickers. I'm going to hand them some money to invest, and let's just see what they can do, whether it's buying calls, selling calls, put
Yeah,
spreads,
but
whatever.
yes,
Okay.
and the holdings are daily transparent. So the thing is, we are not. I would say cover call sort of the first generation type of fund in this space, and with cover call ETFs, you have to accept the fact that over a long period of time, your fund is going to underperform whatever underlying it is tracking. And you can see that with just straight cover call ETFs. And that's because you are trading some of the upside for income, right? We even have this in some of our single names that I think we'll update in a little bit. I think now the vertical has this what they call derivative income has progressed. So we're kind of in the second generation. Tech Titans, we will not be able to outperform KQQQ if we just did a simple cover call. We're outperforming Triple Q right now. So in this vein here, we will not just do a straight cover call. We will do different option strategies depending on what is the condition for the underlying holdings. Yeah.
Okay. Well, thank you very much. Congratulations on the new fund and immediate success, up 2%, almost 90,000 in volume. So, Ambassador, I'm going to yield my time.
Great questions as always. Very appreciative. Howard, I just wanted to confirm. In most of your other funds, you're on a monthly pay schedule, but it has been stated in several different communications that this will have a pay cadence of weekly. Is that accurate?
Yes, that's right. And that's because of the feedback we've gotten from folks. So this is the first, and I don't know if it's going to be the only, but the first weekly that we're doing. Yeah.
Well, we appreciate you listening, and we're grateful. So some of the takeaways that I had was that this is going to be, I'm going to use the word extremely only because you have such a wide tool belt, but extremely actively managed. The selection of equities is going to be based on your expertise. And even though we really can't say target, you've inferred that we could expect possibly yields above the 28%. Am I encapsulating that correctly?
Yeah, I think that's right.
All right. So it looks like the working investor had his hands up before we move on. Did you have a question, comment, or something you'd like to share?
Yes, thank you so much for having me on, Howard. Pleasure to meet you, Ambassador. Thank you so much. So yes, I'm a YouTuber and also do a lot of options trading, and I'm glad that you explained the equity portion. But the option overlay, what I love about your funds with KQQQ, and this will go to KYLD, is that I like the trifecta: the focus on the focus on income, the focus on growth, and also you're looking at the downside of the market. You're also putting in those protected puts, like you have on MAGS. And I like how you do selective, what option strategy you do selectively. My question is, and with KYLD, what would be like your bread and butter style of trading? Like, would it be strictly a cover call with capped upside, or would it be call credit spread where you have like a limited capped upside? Like what would be the overarching like theme? And of course, I like how you're very selective with it. And would it be something like you do with your amazing fund with KGLD, with the focus is to outperform the underlier, which I love how you do. You do dynamic leverage on that by putting on increased synthetics, or would it be to try to have a little bit of a balance, like kind of have like kind of track whatever. It's hard to figure out the benchmark, but sorry about the kids in the back here. And try to give some income, but also gives a little bit of growth, and also and also give some downside protection. Sorry about the kids there, but I'll go ahead and give you a chance. Sorry.
No worries. I don't know how technical can I be on I don't know if people know Greeks or options or whatnot.
If you get to a spot where I think we need some explanation, I'll just interrupt and ask you to do it in plainer English. Is that all right? Go ahead.
Yeah. Okay. So the reason why a cover call usually underperforms is because your exposure to the underlying is less than 1, right? So if you own the stock and you write a 30 delta call, your exposure to that is 0.1, 0.7. So if the stock goes up 1%, your position, the stock plus the call goes up 0.7%, right? That's why you would consistently underperform. Conversely, if the stock falls, you fall less, but you have a lower beta exposure, right? So in gold, and we will deploy this in there, is that we want to be Delta 1. So and this is where some of
And
you guys.
Delta 1 means you're moving in concert with the underlying, that it's
Correct.
equal. One is equal, right?
Correct. Yes. So if the stock goes up 1, your position plus whatever options you have is going up 1. If the stock goes down 1, then your combination is going to go down 1. Yeah. So I know there was some folks who were looking at this leverage question that's in a the leverage question is really actually to this point. So what we can do is get maybe 1.2 on the underlying position, and then we can write a 20 delta call so that the long and the option gives us 1. So in a traditional sense, when you're writing a call right now, you stop your upside, right? So in that combination, you can actually, the stock goes up, we can write it up, but at the same time, we can generate income through that call. So that is one way in which we can not cap upside and then also generate income. And that's actually what we pretty do consistently in K Gold, which is another strategy that we have, where if you see, actually, there's some competitor in that space, they just do a straight cover call. They, as I mentioned, it's no fault of theirs. It's just by construction, they will underperform the underlying. Versus the way that we've run it, we've been able to, keep track of the price of gold pretty closely. So those are some tricks or some strategies that we've used so that you can both have price appreciation and income at the same time. Yeah.
Thank you so very much, Howard. We are going to move on and talk about ULTI. So if you'd like to stick around, please feel welcome. But if you need to jet and have some coffee or go back to bed back out in Cali, please feel free to do so. And if you do leave, I just want to thank you and say that you're just so gracious to come and spend time with us. But if you'd like to stick around, great. People might have some follow-up questions for you, or when we get into the comparison portion of the space, if you want to chime in, that would be wonderful.
Sure. And thanks for everybody. I'll stay on for a little bit, and then if there are any questions, let me know.
Perfect. We'll see how that goes. All right. So I think we've given a nice base information. We haven't gone too granular into every single trade, but we certainly can if that's what we want to do later. But what I wanted to do is make sure we looked at both and then kind of compared. So we're going to move to Max, give him the floor, and he's going to go ahead and give us an overview and then a little more granular on ULTI. That's the Rec Shares version that also spinned up yesterday. Max, you got it.
All right. Can you hear me? Can you hear me? Hello?
Yeah, we can hear you,
Just
Max.
make sure that my mute button's stuck. Okay. Well, yes. ULTI. Okay. Well, I wanted to talk about the strategy, and I'm just going to make this really quick because I can go too deep in the weeds. Their stock selection looks like competitors. I see a lot of names that are in some of our other favorite funds, or some of my other favorite funds, like Iron, Figma, Clean Spark, Circle, Bloom Energy, AST Space Mobile, New Scale. So very familiar with stock names. They have 4% of each. They don't seem to weight them by more momentum. They have it straight across the board. And they have what's called they have an overlay. That means they're going to own stock and they're going to do some kind of option strategy on top. The option strategy they're doing on top doesn't require them to own stock. It doesn't at all. You could do they're doing a butterfly, a fly, iron fly. But anyway, you can do an iron fly yourself without stock, and it's a way to try to earn an income, and it really works well in kind of a sideways to stable market. Well, anyway, they're doing an overlay, so they're actually long the stock at the same time they have the income overlay on top of it. The only thing I wanted to say really quick is it says in their prospectus, the advisor evaluates the performance of each underlying security. When the advisor expects underlying securities value to appreciate, the strategy is structured to capture additional capital appreciation. Conversely, if the advisor anticipates a decline, the option strategy is designed to mitigate potential losses. Okay. I wanted to push back on some stuff I saw on the internet. This strategy they have on right now doesn't have any loss mitigation in it. If the markets limit down Monday morning, this thing's going to be down also big time. Yes, they do have a put, but they've also sold a put anyway, so they don't have downside mitigation. And I don't think this is supposed to. I think they're bullish right now. The way I'm reading the prospectus, and I wish somebody from the company was on here, it looks like they'll do a different strategy, maybe if the market turns or if they see something. So I think right now they're full bore bullish. There's no downside mitigation. You're going to get full downside in this, but you're also going to get large parts of the upside. So anyway, I was hoping that somebody would come on from the thing, but that's about all I got. I can answer. I can talk more.
Yeah, let me ask a few questions as like somebody who might be looking at investing in this, and then you can kind of help us out. Is that all right, Max?
Sure.
Okay. And to that point, I did invite Rec Shares to come on as well as the PM Matt. I don't see them in the audience. If they are here and I'm not seeing them, please raise your hand. But to go over, so it appears that the equities that were selected for the fund, it looks like they've kind of based it on IV to make sure that they have the highest potential to capture premium. Would that be an accurate statement?
Yes, and it looks like, yes, exactly. It looks like they're choosing the high IV, but also liquid. I'm sure these are liquid as well, but high IV for sure.
Okay, and then what I noticed when I was looking at the funds is a majority of the option overlay. Well, let me get to that second. But I also noticed that they basically have purchased the equities, like you said, for all the funds that all the equities they have, they've actually purchased them outright and own them.
I didn't say that, but I should have. They actually own the stock at the same time they're doing an option strategy. And like I say, they don't have to own the two of them together, but they do, and that's kind of the magic of this strategy.
So they actually own the equity so that they have full notional exposure to the movement, either upside or downside.
Yes, sir.
Okay, and then it looks like a majority of them, I think almost all except two, had a 4-leg trade on. Is that accurate?
That's the way I'm looking at it too. Yes, I saw iron butterflies all across the board, but.
And can you in layman's term for all of us so that we understand, since we might not know iron butterfly and condors and income spreads and all that stuff, would you just kind of explain what those 4 legs are?
All right, I think more people might be familiar with an iron condor, but an iron condor is an option trade where you are expecting the market to stay in a range between 2 points. Iron butterfly is the same thing. It's just a little bit different construction. I don't want to get too far into it, but also a lot of people might know what a straddle is, where you sell a call and a put at the money. The problem with the straddles are you have unlimited loss on both sides, potential for loss on both sides. So this an iron butterfly is a straddle with wings on it to define your loss is one way to look at it. Another way to look at it is a different version of an iron condor, but you're looking for stable prices.
Okay, so what I noticed is on a majority of the trades, we won't get into all of them, but on a majority of them, what they've done is they've sold a call and sold a put at the same strike, and then also bought a call out of the money and bought a put out of the money. Is that accurate?
That's right. Then they're buying the call and the put out of the money to define their loss on the income overlay. The reason I said this has no downside mitigation is because then then they own the stock on top of that. The stock's down 5%. This thing will be down 5% too.
Okay, so with that style trade, what I'm looking at it, what they're hoping for is for the price not to go outside of their bought strategies so that they capture premium, they keep it, and then hope that the share price is either staying flat or going up, so they get some of the upside with their actual holding. Would that be accurate?
I think they're rooting for higher prices. They own the stock. They want higher prices. I think what they'll do is they'll recenter. They'll move the strikes as the prices move up. And when they recenter, they'll create either a capital loss or sometimes a capital loss or a capital gain. And then they'll use that money to pay the weekly income. And one other thing I should have mentioned that's key, they're doing monthly options, which is a good strategy, but it's hard to pay weekly income with monthly options. But you watch, what they'll do is they'll roll these structures with the market, and like I say, they'll either create a return of capital situation, or lots of times they'll create a profit situation. But in any event, they'll use that money to pay you.
So when I sell the call and sell the put at the same strike, which is going to be close to the price, I'm getting paid a really juicy premium for that, and then I'm taking part of that money and I'm buying the call and the put out of the money and keeping the difference between the two. Is that accurate?
Yes, that is accurate.
Okay, in a strategy like that, what might I expect is a premium return on that kind of strategy?
I really don't know. I mean, I'd just be guessing. I've never done. I don't do these kinds of trades. I don't like butterflies, condors. I just don't know. Maybe somebody else would. But I don't know. I don't think that's their deal. They want the price to go up. This is a bullish fund. I mean, it's going to be they want prices to go up. And think about this: there's a competitor that does one whose name will go unmentioned, but begins with a B. Also wants prices to go up, period. And they also do some kind of overlay strategy, but they're rooting for higher prices.
Okay, and you did mention that the options contracts that they purchased are basically 4 weeks out. They're not ones that you would find on individual. In other words, if I went to the option chain, I can't see it. So they're using flex options out there, which means that they pick their expiration date outside of what would be on the normal options chain for a retail investor.
Yes, it would appear they have their first round of options expiring on the 25th, and normal options expire on the 21st. But if you look at their competitors that are in this space, they're all using weekly options. But these guys I think that's how they're going to differentiate themselves. They're using a monthly strategy, but they're going to make it a synthetic weekly strategy by rolling every week and peeling off some of that monthly income.
Yeah, so as the price moves, if it moves in a way that they're able to basically roll and capture some income, they're going to be much more active than the 4 weeks that they've set for the expiration date. Is that my understanding?
Yeah, I think they'll look at what happens every week, and then they'll choose some to roll, and they'll make their decision. But then their rolls will pay for the weekly income. That's just a guess. I would love to talk to them, but that's the way I have it figured out. So.
All right. And anything else you want to share about either the holdings or the strategy just in general? And of course, this is just your opinion and your thought process, so we understand that. But any other items you want to share about either of those things?
Yeah. So I'm just hung up on there's nothing I love. Nothing gets me going as much as downside protection. It's hedges and stuff. This thing does not have any mitigating strategies in here right now. You need to mitigate your own losses with this thing. But what I think these guys are going to do, these guys are pros. And if we get in a situation like March and April, where, or we get in a situation where it's precarious or whatever they're looking at, they will, I think based on the prospectus, I think they might switch to callers or might switch to something with some real downside mitigation, because what they have now doesn't have it.
And that would be accurate per their prospectus. They have those tools in the tool chest, correct?
Absolutely.
All right. Excellent. All right. So we're going to go ahead and move on unless there's some more questions regarding ULTI, and we're going to give the floor to the ETF Delta. And what we're going to ask him to do is kind of compare the two, maybe even bring in the other kind of strategy that is, or the other fund that's kind of like the strategy, kind of give us a comparison, a thought process, what he's seeing from an overall standpoint, and let him riff on that for a little while. Delta, how are you?
Doing well. This has been very informative. Thank you so much, Howard, for coming on. Nice to meet you as well. And yeah, kudos to the general performance you've achieved over at Curve. I'm especially, keeping an eye on KQQQ, and it was one of those ones that made the short list for, out of all these hundreds of derivative income ETFs that we all talk about every day, it was like one of 7 that actually had rebounded. NAV had rebounded past the highs of February before the April crash, and has delivered strong performance. So excited to see how K Yield will fare as well with your strategy. I guess second thing I wanted to say to kick off this segment is, like, competition is healthy. We've talked about this before, but basically it's giving you more flavors in the ice cream shop so that investors can determine what they want that aligns with their goals, aligns with their risk management risk profile. And so competition breeds innovation, and it really puts the pressure on these issuers and these portfolio managers to strive for the best performance. Because at the end of the day, whether it's covered calls, whether it's derivative income, whether it's custom strategies or using leverage, I think it's clear through Twitter and Reddit and the likes, people just want performance, right? They're very curious on what's under the hood, but at the end of the day, they're putting their dollars where the performance lies. And so it's really exciting as we sort of head into the end of the year now to have increased competition, hyper actively managed income funds that are built off of a basket of underlying. So we can dig into that a little now. I think, I really appreciate Howard diving into the thematic approach, because that just paints an extra layer of the thought process and the strategy, right? It's not just the pursuit of the highest IVs. And what I like about the thematic strategy is within each theme, right? He talked about sort of the Rails theme, where it was perhaps Coinbase or AppLovin or Shopify. Those technically, I guess I like to categorize sectors in a more retail friendly way. I think the official industry and sector classifications that are used on brokerage platforms and at the institutional level are a bit too high level for someone to actually understand what this business is, because they just lump so many different companies into different things. So with these themes, AppLovin and Shopify are technically in different sectors. They yield their revenues in different ways, but it makes sense when you look at it through a bucket. So I think that's an interesting approach for K Yield. And diving into that one first, just in terms of comparison, I mean, we talked about a bit of the holdings, right? There are familiar names like Galaxy, like Robinhood, like HIMS. And then there's the precious metal piece, like the gold and silver miners. And then there's the bigger tech pieces like Intel and Broadcom. And so I guess when you break it across sectors, and I'll write up some of this weekend in sort of a high yield monthly recap that covers these funds and Ulti, but it's rather broad, right, in terms of the depth of sectors and that type of diversification. And myself, Max, ETF Inspector, right, I think if Rod is still here, we sort of pull the average 30-day rolling IV from some third-party websites. We know it's not necessarily a one-to-one match with the active IVs of all the different options and underlyings. But when we sort of just use the numbers comparatively, even if they're not the actual numbers, sort of the 30-day IV lands around 0.65, I believe, for the K Yield holdings. And so now if we sort of dip into ULTI, and I'm very curious how rec shares would call themselves. So maybe we can then end up with differentiation between saying Ulti and Ulti and Ulti. But I actually like K Yield. That had never crossed my mind. I was always going to call it KYLD, but K yield makes sense. Nonetheless, for ULTI from Rec Shares, like we mentioned, it's the high ID names, right? Very similar to Ulti. They have classics and staples in there that had been core holdings in Ulti for a long time: ASTS, Nebis, SMR. And then they started to get into a few others like the Trade Desk, TTD, Lemonade as well. And what's interesting here, obviously, if they're in the pursuit of the highest IV, is the average 30-day IV on some of these third-party sites, when you aggregate it all across holdings, comes out to about 1.1. And then Ulti, its current holdings, comes out to about 1. So that's not a good thing or a bad thing, because obviously the higher you strive for yield and distribution rates, the higher the trade-offs for NAV performance, NAV evolution, total returns, and the likes. So again, it goes back to the ice cream flavor selection. As these funds mature and we get to see performance over the next few weeks, over the next few months, that's going to allow investors to really determine how much allocation they may want to put into any of these or all of these, and what their blended performance is going to look like as they strive to balance that trifecta of NAV growth and appreciation, ideally income, and total returns. And so I'm not going to put Howard on the spot here, and I know he needs to go through formal announcements and the likes, but I guess just based on that math, right, and using some of these average numbers, if the K yield basket is sort of averaging a 0.65 and the other two are averaging a 1, and we know the yields that the others are perhaps paying out, and perhaps sometimes, right, they're just paying out, and some of that is sort of principal coming back in an ROC way, then perhaps you could expect that K yield to be about 65% of Ulti or something like that. And then obviously greater than 30, kind of how Howard alluded to. Maybe that's wrong, maybe that's right, but I guess those are just some numbers I'm looking at to see how that plays out. We know often, as Howard alluded to as well, and we've seen it in many other funds, that first distribution is often a little not representative of what the norm would be over time, if that's the right way to put it. So whether it's Ulti, whether it's K yield, ULTI, as these first distributions roll out, it's certainly not, I guess, the indication of the status quo. And so I think investors who are considering these funds should have that expectation already in place of it could take multiple weeks to allow these funds to ramp up and sort of get a baseline of performance. The last thing I would just want to cover a little is the overlapping nature. Now, what's interesting is obviously there's a finite amount of stocks available in the ecosphere that can provide the amount of volatility needed to properly harvest income and distribute that to investors. But what's interesting is both K yield and ULTI each have about 20% overlap in holdings with Ulti, but in different ways. So when we look at K yield, some of the overlap with Ulti is Robinhood, it's Coinbase, it's HIMS, it's Bitmine Immersion, BMNR. On the flip side, when we look at ULTI, and that around roughly 20% holdings overlap with Ulti, it's more IREN, SMR, Rocket Labs, RKLB, and Upstart. And so it is sort of this Venn diagram looking thing. Now, K yield and ULTI actually don't have any overlap for now. And so it really does, I'll just keep harping on the ice cream flavor analogy of what's nice is that these are not three copycat funds that are all vying to deliver the same thing. They all have different objectives and goals, which is going to resonate with different pools of the audience and investor base, who all each have individual expectations for what they're looking for, whether it's max income, whether it's NAV appreciation and income, and the likes. And I guess the last thing I will sort of pause there, and then we can dive into more open discussions or questions and share other thoughts that we all have. But just in terms of some high level sector allocation, right? So getting a little more granular beyond themes. We've talked a lot about crypto in the past when it came to Ulti. I think right now, K Yield has a little over 20%, let's call it, like crypto and crypto related name exposure. ULTI has about 30%, and then Ulti has about 28%. So K Yield is skewing a little less crypto exposure. Again, not a good thing or a bad thing, just you have to be, like, we've heard this from so many different people. We've heard it from Mike Coe as well, Michael Coe, right? You have to be bullish on the basket. You have to be bullish on the underlying to really believe in the investment thesis of these funds, if that's your intention. And so some people may be attracted to different sectors than others. I think on the quantum AI side of things, which I had personally split out as different than like the semiconductor side of things or the chip side. So this is more just those, let's call it like meme related AI quantum names that have run up, thousands of percent. K Yield actually skews lower on that spectrum, right? Around 7 to 8%, whereas ULTI is 10%. Ulti is actually at like 27%. And then when you talk more about different types of energy names, whether it's nuclear, whether it's solar, whether it's some of these other names, at least in this general categorization that I had spun up, K Yield actually comes out at about 11% exposure. ULTI is about 20%. Ulti is about 8%. So it spans the spectrum of what do you want to invest in? Who do you believe is sort of allocating their basket across different sectors and strategies? Because there's no wrong answer. And obviously the basket sort of pairs the implied volatility and the income. But it's not just about income, right? It's about net appreciation, total returns, all of that. So again, not a good or bad thing. Hopefully that's insightful to folks who are just wondering what the composition is of these, because 20 stocks for an average person to look at and realize what they're getting into is a lot to take in. So hopefully in some of this basket related analysis or sector related analysis, they can sort of see who's taking riskier bets, who's a bit more diversified, and there's a place and time for both of those.
Great analysis. I appreciate looking at it and being able to kind of to look at the different ones side by side, even though strategies are different, holdings are different. It helps us in general. TWI, I'm going to come to you in a second, but before I do, I just wanted to go back to Howard. He's been gracious enough to stick around through all of this and us talking about a different fund. I wanted to give him an opportunity to kind of wrap up anything that he wanted to, maybe express who his fund is targeted to or where it might fit in a portfolio. If he was talking to my grandma, what would he recommend? I know he can't give recommendations specifically, but I wanted to give him an opportunity to kind of to wrap up anything that he wanted to say or respond to anything that he's heard so far before we move on.
Thank you. Yeah, I think the strategy is built for somebody who is using the income that we are generating and not reinvesting it into back into the fund completely. And I think we, I think for most of us who are not looking at the markets every day, they want something that they can rely on. And they don't have time to look through all the holdings, so they want to make sure that it's something that hopefully will be an ongoing concern, and that they'll get some price appreciation on top of that. So that's where we're focused on for all of our funds. And so one thing just to add is that the portfolio now probably will look a little bit different next week as we um, move out of earning seasons, and so that is something that well, if you're busy, you're not going to notice it, but hopefully that will result into more stable NAV and more consistent income, and all of the and that's it. And then that I would say all of the discussion here is actually pretty right on, both in terms of what our intentions are and picking out what we're doing in the portfolio. So appreciate that. It's always good to have good representation of what you're doing in the strategy. The hardest is um, people saying things that you're not doing. That's always a concern of us. But everybody here is really on top of the game, and that's it. And unless there's any other questions, I think I will drop off and go get a cup of coffee.
Yes, well deserved cup of coffee there, Howard. Thank you again. You have an open invitation anytime to come back. You want to set a record straight or just announce something, please know DMs are always open and you have an open and welcome invitation. I personally, speaking for myself only, I love what you're doing. I echo your sentiment that total return is a great way in the classroom to look at these compared apple to apple, but they're not. It's not the best way to look at it from a standpoint of an intent if you're looking for income. So I'm glad I'm not the only one out there in the space that feels that same way. Thank you so much.
Yeah, and Howard, when we have a chance, definitely one time want to go over the
TWI,
guts.
can you hold on 1 second?
Sure.
Inspector has a hard cap deadline, and I want to make sure I get to him before he has to cut out. I'll come right back to you, I promise. Inspector, go ahead, sir.
Sorry about that. So I just wanted to ask Howard one more question, a clarifying question before he goes. Not trying to put you on the spot, so maybe you might need to get back to us on an answer. But there was one thing that I pointed out in my video that I made that was a little concerning. So if I go to the website for KYLD and I start reading in the important risk information that's about middle of the page, there's one section that says there is no guarantee that the fund's investment strategy will be properly implemented. So I understand a lot of the times they say there's no guarantee that it's going to work, or there's no guarantees of making money. You could lose money, but to say, all right, like, here's how we're going to invest your money, invest it with us, but to have a line that says there's no guarantee that we're going to properly implement our own strategy. So is that maybe just a wording error that needs to be corrected, or am I understanding it wrong?
I will take a look. I think a lot of times, so all of our websites are reviewed by the distributor who I think they take the risk if something goes wrong. So they usually put languages that are um, basically all of these disclosures is meant to, try to ward off whatever sort of issues they have. So I'll take a look. I think um, we implement what we implement. So I think um, maybe it could be addressing if there were traders, but I think that's pretty not. Uh, I mean, that could happen, but I think that's not likely. But I'll take a look at that. I don't. I'm not sure if that's a mistake or if it's on all the other pages. I think I'll take a look at if it's a disclosure that is across all the different funds. Sometimes what they do is just to have a catch-all disclosure. I mean, like if you look at most of these fund web pages with a lot of disclosures behind, it basically is like trying to catch everything. But um,
I've seen that on many other funds. I think it's. My guess would be it's a standard
I
disclaimer.
think it's
'Cause I've seen a lot of. Yeah.
I think so. So what I'm here. So the way that we manage it, we have a very strict trade compliance processes that will hopefully catch any mistakes that goes before it goes into the portfolio. And I don't. So far, I think all of our strategies we've implemented what we intend to implement. So I think from a practical basis, um, we're kind of we're good there.
Okay, thank you.
All right. Well, have a good weekend. I'm gonna thanks everybody again for joining for actually an hour. So thank you. Appreciate it. Bye.
If I may, I mean, I know Howard Howard left. But I was going to make a comment and then a question, but I guess the question will be for a different time. But the comment would be that when it comes to these income funds, I look at two different things. There's the underlying, especially thematic funds, because thematic funds have the liberty of choosing, or open thematic funds, like that have the liberty of choosing any type of underlying they want. And especially like the KY, K yield and ULTI, ULTY, so they have a lot of liberty. So they can choose whatever they like, and they have to have a home run in that. And then there's the option overlay, which changes. With options, options can make your underlying, your overall basket more risky or less risky. And every option strategy has pros and cons. So it's about picking the right mix of underlyings, and it's about picking the right strategy that's appropriate in the right market environment for the right type of underlying. Because what I like about these funds, they're not like a one-trick pony. They're not restricted to cover call, synthetic cover call. They're not restricted to put spreads. They have all the liberty. When you look at the prospectus, they have all the liberty to use whatever tool they like. And that's why I love these spaces, Ambassador, you put on, because only by talking to the fund managers, we can understand.
It's a little distracting with the noise in the background. Do you think you could?
Yeah, I'll move to a different.
That's problem.
Yeah,
just
so
go ahead and land the plane, because I want to go around the panel and
okay. All I was gonna say was the context is everything. The context is everything. So that's what I wanted to say. And it's not just the income; it's the outcome. And the last thing I was gonna say with his equities, what I think maybe ETF Inspector missed or didn't point out was that he also has gold miners and silver miners that have a very low correlation to like the Qs. So that itself is like a risk parity built in. It has a bit of a risk mitigation within the whole. That's all I wanted to say.
No, great input. Just want to make sure that I get around to the panel here. Kind of get some final thoughts, and then I'd love for some folks to pop up, like Butter or Architect, anybody else, and kind of just give their feeling now that they've seen and heard and been around the funds for a couple days now, or since they launched on Friday, if they've got any opinions about that. I'll go to Inspector, because you've got the hard cap. Any final thoughts or kind of wrap up things that you'd like to share?
So a final thought, I would say that Howard did himself a great service by coming on here, because from just looking at the holdings and not being able to talk to anybody and having limited information, I was less than interested in KYLD. And then after hearing him speak and explain things to us, I've become interested. So he did a great job for himself and his company by getting up early on a Saturday morning to come on here and talk to us. Now on the Ulti side of things, Max, the thing that jumped out at me, and I wanted to get your opinion, doesn't it seem strange to have a collection of high implied volatility funds and then place a neutral strategy bet on all of them with an iron butterfly?
I am so glad you asked that question. That's the same one I had.
And then I also noticed while the Iron Butterfly is a neutral strategy, the strike selection is actually, well, at the time of the placement on the holdings, the strike position was selected above the current share price. So they would actually need the underlyings to move up to get into the sweet spot on the strike. I'd say on 90% of them. There were a couple that were like at the money. Most of them actually needed to move up to hit that sweet spot of the short call and put. Okay. All right. Thank you guys.
ETF Inspector, thank you so much. If you got to pop off because I know you have a hard cap, please know that we're appreciative of your time and effort and helping us understand these. And you had the toughest job because you had to talk about a fund where the fund manager was right here. So kudos to you, my brother. I did want to pop over to Butterstrike as somebody who works in the finance industry and is curtailed on what you can own and what you can't. Are two more offerings of basket funds like this exciting to you?
Yes. Can you guys hear me?
Yes.
Awesome. Yes. Big yes. Yes. I mean, anytime one of these issuers, offer any basket style funds, I'm hyped, right? Especially if it's weekly paying, diversified, sector related, right? And you know what's funny though? When right at the end, I forgot what Howard was asked about, but he hit to the point where a lot of folks use these distributions as like solely income, right? And they're trying their best to not overpay or how do you say it? Like the whole NAV decay concept, right? So they're trying their best to mitigate that by capturing, I would say, more upside or have our NAV stable while they are dishing out distributions for us, right? Whether if it's like 28% or 35%, I think that doesn't really matter at this point. It's just more like whoever the issuer is that can discover the secret sauce of distributing income weekly or twice a week, right? And for another fund, if they can do that while also mitigating NAV decay, I think they've got themselves a unicorn and they should see money flying into the fund like any day, right? I guess that's what everybody's looking for, is that trajectory of the price being, left to right, not so down, but goes up a little bit. It's okay to be down slightly, but if you compare that with nice even income distributions, I think that's wonderful. Because if you look at how ULTY was trending ever since the tariffs to like end of July, like AUM skyrocketed because the fund was paying really, really well, but also the NAV didn't dent, right? It appreciated, right? Just because the market was exploding, right?
Yeah.
From the huge sell-off. So from that pattern, I can totally see what we are totally looking for, right? Is that sort of, hey, can the house appreciate and can we get rental income that doesn't disturb the capital that we put in, right? So I think we have something here, guys. We just got to see how it goes going forward. So yeah.
Yeah,
thanks.
and I think we can take a clue from the way he was talking, even though he wouldn't say it. He kept referring to 30 and 35, and to ETF Delta's point, if you take the beta there and what he's doing from the IV, it looks like the target, if you just were doing quick math, would be around the 55%. So I think he's comfortable in that 30 to 35%, kind of flattening it out and returning that stuff. I do want to go ahead and to fix your money. You had your hand up. I'd love to hear what you have to say.
Yes, I had a quick question. So I've always I invest in ULTY and Salty. And I was always thinking, why don't they, because you can have 30 stocks, why don't they combine it so they can trade both ways? Do you think ULTI will be something like that?
Anybody on the panel want to take that?
No, I don't think I don't think they're going to do that. But we don't know. It should be interesting. I think what they'll do is they'll adjust their option positions. They'll adjust their overlay to have downside protection. In other words, they'll put on a collar or a put spread, risk reversal or something whenever or a call spread risk reversal whenever they expect lower prices. I bet you they're still going to be a long focused fund. I asked Jay Petrocelli a long time ago, last summer, to combine Tesla and Crash, trade them both together and manage it as a pair and call it cake. Have your cake and eat it too. He laughed me out of the room. I mean, he's a nice guy, but they aren't going to do that. He said, hell, you can do that yourself. So
I would add, I think Neos filed a short long ETF that might be coming out by the end of the year, if not early next year. So it's not a one for one in the sense of combining an Ulti and Salty, but there is a component of blending short and long exposure. I think it's either like 60-40 or 70-30 or something like that. So that might be the first of those hybrid funds that we can track and monitor performance. And if it is successful, it may lead to others wanting to follow suit in their own unique ways.
Agreed.
Did that help you and answer the question there?
Yeah, definitely. I mean, it's just in my mind, it's the point of it will help the NAV stay a little bit stable, but not perfect. And it's just in my train of thought of I'm an advisor. I've been doing it for 18 years. And when I look at these funds, like, why not? You know what I mean? You have enough options out there, and you don't have to trade on the same exact stock.
Makes perfect sense. Thanks for popping up. Hang out if you like. Pop in if you have. But I want to move over to the architect. Welcome. Thanks for popping in. How are you? How's beach life? And what's your sense of these two new funds that got spun up?
Well, one, I have Howard coming on Monday, so I'm going to go back and listen because I joined in late and get any list of questions. And I'll ask them on Monday and get them on the record. Howard's been very upfront and honest. And then there's the new fund, ULTI. That's already reached out to me, and they will be coming onto the channel. So that was a perfect question. Can they rotate to going short? I'll just ask the fund manager. He's going to come on the channel. So any questions you guys have, just please list them out, and I'll ask them when I talk to them. That's all I had to say. Thanks.
Excellent.
Thanks, everybody. The ETF Delta did a great job. ETF Inspector, Max. I'm actually thinking some days I want Max to be on with me when I'm interviewing some of these guys because he asked very good questions. So thanks, everyone.
Excellent. And thank you. And if you don't already, go ahead and give the architect a follow here and on YouTube. And he does have a private group. So look into that. Definitely helpful. All right. So, Max, any kind of wrap up thoughts or things you'd like to share before we click on out?
Well, no, I think we did a pretty good job covering it today. Howard sold me. I mean, every time Howard talks, he just makes so much sense. Howard's a different kind of cat. I mean, he's a different breed of cat. He's and it's refreshing and stuff. But I'm taking comments in my live stream too, and they're asking me which one do I like better. And they're different. It's apples and oranges. But if you stuck a gun to my head, I like the option overlay exotic strategy with it'd be ULTI if you stuck a gun to my head, but please don't do that.
Yeah. Well, we appreciate your transparency and great breakdown as always, Max. You are a treasure to the community. ETF Delta, any wrap-up thoughts or things you'd like to share?
This was super informative. I mean, as much as we can help provide our thoughts and some data analysis on these ETFs, having someone come on who actually runs it to explain and help fill in the gaps between the lines is super awesome. I think his mindset and approach, right? And that's where again, flavors of ice cream, but like you can tell if you are bullish and interested in curve ETFs, their focus is on NAV appreciation and income, and thus total returns will also be favorable. That comes at let's call it high yield. I think actually, I've been baking this into my writing. I know others are too, but it's like I treat high yield as okay, let's say above 12%, ultra high yield, perhaps above 50% and the likes, and those have their trade-offs. One thing I would also just mention, right, which seems to be a sticking point across many who are just diving into these funds is, as much as a fund tries to achieve NAV appreciation, just be reminded that when you're hitting that sort of delta one that Howard was talking about, yes, that implies you're equally moving with the underlying, and that applies to the downside as well. And the protection a lot of these funds put on helps, but nothing will mitigate things 100%. So if and when there is a market pullback, stocks and equities and fund ETFs and income ETFs, they'll all likely go down. What the most critical thing is, though, as you're analyzing these, is likely the question you should be asking yourself is not, oh, I hope mine doesn't go down. It's once it's down, how likely can it rebound? And so I think that's an interesting just phrasing. I think these ETFs, they can launch whenever. It's nice they're launching now because it's providing more variety heading into 2026. I think what's interesting is they might sort of become battle tested rather quickly if there is that market pullback, and you'll get to see how they operate in non-ideal conditions. We've been spoiled over the last 4 to 5, 6 months, since April, where all of these funds are trending up and to the right in terms of total returns because the market has been ripping. And only now over let's say the last 2 months, you're starting to see how some of these funds start to fatigue, so to speak. And so that's valuable insight. Like, obviously you don't want to see that because you're playing with your real money, but that's actually a very strong learning opportunity when you're starting to plan well into the future, not just in the short term. So I'm excited for all of this competition. I think it's healthy. I think we'll have to really see over the next 3-4 weeks into the months ahead the true performance of these. But the variety is awesome because there's different strokes for different folks, and between these three plus everything else that's out there in the world, it's endless opportunities to build your own income portfolio and tweak it and balance it to hit the goals that people are setting for themselves.
Salient points as usual, Delta. Appreciate you so very much. I do want to hit up Butterstrike, but I also want to invite Amy on up, as she's somebody that actually uses these funds, follows them, has an amazing website to track them, but she's also using them for actual income right now. I'd love to hear her thoughts also. But Butterstrike, anything you want to share with us or close up before we head on out?
No, I don't. Wow, it's actually an honor to have you ask me to close. But yeah, I'd like to reiterate the point that ETF Delta just talked about in regards to like the rebounding and stuff. A lot of these funds, they do tend to drop, right? Even if you have protective puts and everything, if the market's downturn, every one of these income funds is gonna downturn, right? I think it's just a matter of your own financial acumen. Like if you take everything as income and not reinvest or saving up for the future, that's something that I think can help, is that don't spend all of it, because downturns will happen and can happen anytime. And it's up to you as your own personal investor to know when to get back in, right? Nobody's going to tell you when, right? So for me, I have these distributions ready from YMAX and Ulti and all that sorts, and I'm ready to go back in when the markets hit a pivotal point, right? So hopefully people see that protective puts, that ULTY or TI or KYLD is having. It doesn't necessarily mean it's going to stop a drop tremendously, but hopefully it comes out fine, and we can be more happy in the future with better income that we can snowball with. So yeah, that's all I have really. Thanks.
Great insight as normal, Butter. One of my favorite out there. Go ahead and give him a follow. Amy, I want to come over to you, then TWI and David. I'd love for you to pop up. I'd love to chat at you just for a second. Amy, what have you heard? What have you learned? What do you like? What don't you like? What's in your mind about these new roll-ups?
I think I have been sick all week, and so I've been not very keyed into this. But I watched Max's YouTube video about ULTI this morning, at least most of it. So I think that these will be great additions to YieldMight, which is a high income ETF comparison tool. We have to keep in mind that, like, at least for ULTI, it does include speculative companies. So it does have a high likelihood that it might not go the way that you want it to because it's speculative.
Amy, I'm so sorry you're not feeling well. You sound like you're so under the weather. So we're going to definitely pray that you get better and heal up quickly. TWI, any closing thoughts or ideas that you want to make sure you share with folks before we head on out?
Absolutely. Thank you so much for allowing me to give closing thoughts. So yeah, I just want to say I'm super looking forward to Income Architect's interview with Howard. I love all the stuff that he does. My only request is if you can go into the guts of like the option, strategy, because I feel like he did a great job explaining the reason for selecting the equity, the underlyings. And I do like that he has a mix of miners and tech stocks, which have less correlation in there. So there's a little bit of a hedge built in that way because it's a risk pair, it's uncorrelated assets, both with positive drift. But yeah, if you can just go into the guts of and bolts of like how the sausage is made, that would be super appreciated. I love all the stuff you do, and thank you so much, Ambassador, for having me on, and everybody else. And I hope you feel better, Mr. Roundhill, and hello to David. Bye.
Hello, and David, I've given you a couple invites, so if you can't speak, I totally get that. But if you can, go ahead and pop on up. All right. With that said, I think we did a decent job of kind of pulling back the hood a little bit on both the funds. Howard did an amazing job of describing his fund. Obviously, it's his. He made the selections. He's looking at it. But I think it definitely gave us a definite separation of the two funds that just spun up, what they are, and then it's your determination on which one fits you and how you want to invest your fiat and your time that you had with money into these funds. All right, so with that, I'm just going to go to the folks on the panel who were on the panel and let them, if they have something coming up, either a launch or a video or something, just kind of express what those are. ETF Delta, what do you have coming out this week?
I'm going to be doing a monthly performance recap for the month of September for Ulti, but then also layering in now the exposure of these two other funds because I'll be tracking all of them daily. And then I'm working on some longer form research and analysis that really just hopefully paints the picture of long-term performance. I think we have about 2 years of data now across some of these high yield funds. So just exposing some of that to help align investors with their expectations of how these funds tend to shape up over the long term and sort of debunk some of the myths that people believe where they go and plug into a snowball calculator some of these distribution rates and annualized yields, and it spits out telling them they'll be a multimillionaire in 3 years if they just drip at 100%.
Everybody, please, if you don't already, go over and give ETF a follow on X. Also, subscribe to his Substack. Puts out the best information. I mean, it's a wealth of knowledge and information that just helps you as an investor to make good decisions. Inspector, what you got coming out this week? I know it's a lot to list, but anything you want to highlight?
Sure, thanks. Yeah, I'm trying to get ready at the same time, but I put out videos on Friday, just going over ULTI and KYLD. They each got their own separate videos, so if you guys are interested in like a visual breakdown of everything in the holdings, that's in there. And then just on the weekends, I've got my week look ahead and guesstimate videos for the Yield Max funds that I cover.
Yeah, ETF Inspector has just a great assortment of YouTube videos where he breaks down funds, trades, holdings. It just makes you a better and more informed investor and helps you understand some of these derivatives that are out there. Give him a follow on X, but then hop over to the tube and subscribe. Just amazing content. Max, anything you want to share you got coming out this week?
Yes, I do. When Howard was talking about the total return, or he kind of reading between the lines, you talked about how it could be a little bit deceiving, and it's correct. You can have two companies that have the same total return, two ETFs, and they can have vastly, vastly different qualities and good things and bad things. Anyway, I built a metric that I think does a better job than total return. Anyway, long story short, I have a daily show called The Daily Factor, and we look at these. There's 155 stocks in this universe that we look at. And once a day, I'll have a show and we'll look like inside the return and see how the total return is made. No two total returns are created equal. And that's why I had to invent the max factor.
I will concur. The max factor and the show is going to rival and crush Kramer's Fast Money. He will soon be the number one on all. So hop on over to the tube, give him a subscribe. He's live at least 2 or 3 times a day, offering great content, and we appreciate you so much, Max. All right, I'm going to move over because one of my favorite fund managers, and also some of the funds that I'm absolutely most excited about, and I hope that you all get excited about, are going to drop sometime in December. I know he can't get into them completely, but I'd love chance to David to come up and just say hello to the community, introduce himself, and maybe say just a little bit of what he can about what he's got coming out as Christmas presents for all of us.
Yeah, thank you. As always, I'm actually in California at Lake Arrowhead at my cousin's wedding, which was really exciting. Just happened last night on Halloween. I've been in the ETF world for 22 years, and it just warms my heart to hear the level of research that you guys are all doing in so many different offerings. I know Miss Roundhill has her own offering, and ETF Delta, everything you said resonates with everything we are trying to do. I'd love to connect and kind of talk in greater detail at a later date. But I love that you guys are doing this real research. I think what you guys are making obsolete is honestly a platform like Morningstar, right? Like how these ETFs get assessed has to evolve with the complexity of these ETFs. They're no longer just access vehicles. Especially in the income space, we're seeing the value of not just being an access vehicle. I thought ETF Delta, you put it very well when you're talking about, like, realistically, like, how does the beta change in your cover call strategy or something cover call related as markets evolve, as you have that drawdown? You know, there's very simple ways that the institutional world does this, that there are some really good managers out there. I have all the respect in the world for Curve. I think they're a fantastic company. You know, that increases the beta when you're at that peak of the drawdown because there's so much more volatility and so much more income to harvest, and maybe you don't harvest as much of it. And so I really love the conversations that you guys are having, because I think that allows this space to evolve and allows you guys to all make really good research decisions and disseminate really good information amongst your communities. So kudos to all of you guys on that.
Is there anything that you can or would like to say about Edgar filings and the new funds that you're looking to spin up in December?
I mean, what I would say is they've seen your posts. You do a phenomenal job on this space. We are trying to bring this kind of institutional quality to our offerings coming to offer like institutional pairs in stacks, you know, cover call like strategies that can change based on market environments, can use different structures of ways to get the exposure, whether it's put spreads or option spreads or, you know, daily puts, etc. Like there's intelligent ways to do this There's no one way that is a be all end all. So anyone who's trying to sell you that like, oh, I have this new way to do it, it's like, it's not new. If it's available in the ETF wrapper, it's been around the institutional world forever. No one developed a new way to do things. And as ETF Delta said, it's more about like how these vehicles evolve and respond to the markets. And so I think what you guys are really looking for are vehicles that will like take advantage of the market that there is today, not just be like, but hey, this is a cool access product. But it also means that like you can't just buy the fund that had the best 3-month return, right? You actually have to look at the underlying holdings, and that's only really possible, or not holdings, the whole thing, the holdings, the strategies, that's only really possible with all this work you guys are doing. So I'm super excited because we're honestly moving further and further towards what I like to call hedge fund-like vehicles in the ETF wrapper. It makes too much sense. Hedge funds are a legal tax advantage loophole that is better than any other tax structure available in the US. Not to mention, if you have an alternative like vehicle, it's meant to be an ETF so that like at the moment's notice at lunchtime, like if you do too well, like guess what? You should probably trim that position and buy some other things. Like that's what an alternative is meant to be. Like there's still a position for very cheap, cost-effective ETFs in your portfolio, and these are meant to be like satellite positions around those as well. And so we're very excited to offer those. As Ambassador said, we have 6 income stacks coming out, which stack stocks, Bitcoin, gold, and treasuries in all combinations. So we will be coming out with our 200% exposure Bitcoin and gold premium income ETF, as well as like 2 more, what I like to call like true hedge fund ETFs in the MNAV. We're calling it MNAV Harvester series. So the first one will be YTSM. It's a little bit of a play on MSTY. You know, it's a true hedge fund trade where we pair, you know, we will have long beta to Bitcoin, overall about 1.5%. And it'll be a combination of long Bitcoin spreads, and then short Bitcoin treasury company spreads at high MNAVs. And in this market, we could even be long certain Bitcoin treasury companies at low MNAVs. I do think, you know, some of these MNAVs have gotten down to like 0.7, but like it's a strategy that will evolve with the marketplace. If MNAVs are really expensive, we can get really short a lot of them. If they're really cheap, we can pair them versus the long ones. You know, there's money to be made on, for example, if MicroStrategy started buying out other crypto treasury companies that have an MNAV lower than 1. These are real conversations that are happening. There are hedge funds that are theorizing this stuff, and you can do all of this in an ETF. So that one's going to be fun, and these all come out shortly after Christmas. So thank you.
What a country, what a time. It's exciting, and I'm thankful. Thanks for popping up. I know you're busy at a wedding, and I hope that you don't have much of a hangover if there was a lot of partying going on. But thank you for popping up, David, and spending a little time with us. Appreciate it. All right. With that said, if anybody has either a comment or something they'd like to say before we head on off, please raise your hand. Any of the panelists or any of the folks up on the stage, if you want to talk about what's going on or promote anything, this would be the time. If you have a question that we just didn't get to or a topic we didn't get to, please raise your hand. Let me know. All right. I'm not seeing anything currently. So if you've been to any of my spaces, you know that I conclude all my spaces.
All right, guys, can you hear me? I thought that was a pretty good live stream. Sorry, it was probably kind of boring. I mean, for you guys, but anyway, maybe it was a service. If some of you guys don't have an X account, and I realize it's not very engaging content to watch me play guitar, but those guys, it was some good content that those guys generated. They just didn't have very much stuff for me. Anyway, yeah. Good morning, Bank Account Bonus Central. I hadn't seen you around here before. Welcome. Welcome. All right, so we got 31 folks. What do we want to talk about? We don't have to talk about anything, either if you guys don't want to. Just to reiterate some of the stuff that they were talking about, there's a misnomer out there that ULTI, and I've seen other influencers saying this, oh, they have puts, they have downside mitigation. No downside mitigation right now. And but, you know, BLOX doesn't have downside mitigation either. I mean, you don't have to have downside mitigation. Like that David Dobrinsky guy said, there's not just one right way to do it. There are smart ways to do it based on different environments. And at the end of the day, these guys are humans. They may think the market's going to be soft for the next month and put on a position, and they may be wrong. I mean, so but I'm really excited. What I really think is I really think ULTI will switch into callers when the market goes down, and that's what I hope they would do. So in other words, because ULTY, as you guys know, because I never shut up about it, I think it's a great fund that predicts downside better than any of the other funds in the same class. But the problem is that it does that all the time. So it also goes up slower. So that's just kind of what you get. But I'm thinking that the guys over at Rex are trying to make a hybrid, and right now they're just full on bullish, which is great. But I surely hope they're going to switch to a protective structure of some type sometime soon. Have you guys? Okay, which one did I buy? I bought one of them, but then one of them wouldn't let me buy. I forget which one. I want to have equal parts of both, so I bought one of them on Friday. I think it was ULTI that they wouldn't let me buy, or was it KYLD? I don't remember. I don't want to sign on to my Tasty Trade account right now. But in any event, let's hear what you guys say. Bank account bonus central blowing through the calls when the high-V stock shoots up and capping there. Yeah, correct. It isn't. It is not fun at all. So there's a couple of solutions for that. One thing is, instead of using weekly option structures, to go out monthly, because you also trade less income, but you have less problem with that in the grand scheme of things, just statistically, if you back test it. But you still can have problems with that. So I really like what Rex is doing, using monthlies. Now that's going to cut their income in about half. So think about this. They have the same kind of stocks that ULTY has. ULTY pays 80%, but they do it with the collar structure. Okay. These guys, I'm thinking these guys, but they're using weeklies. These guys are using monthlies. So I think it might be more like 60%, 50% for these guys, all else equal. But the monthlies give you a more stable source of income. The other thing is, maybe at times they'll switch to the weeklies. Maybe they're just doing monthlies now because of the shape of the term structure of volatility. They're called the volatility surface. Maybe right now they think the best deal is to go out to monthlies, and the next, and here in a few months they might be doing weeklies or something. So it's probably not very informative for me to guess on looking at one day's worth of trades. But I've been watching all of these ETFs in this industry for 2 years. And, so, I mean, that's just based on my experience. That's what I'm seeing. So, but yeah, I think I got KYLD is what it is. I did. I got KYLD, and they wouldn't let me get Ulti. They said it was closing only. So it's just because it was the first day trading or something. I'll pick it up Monday morning. But I really don't have a favorite. And I mean, if I would have said my favorite before the show was ULTI. But I mean, after I listened to Howard and stuff, he makes so much sense, and it's an apples and oranges comparison. Because Howard is I think the fund that he's trying to do, KYLD, is a growth fund that also pays an income. And I think a lot of these other funds are income funds that might grow if it's convenient or if the conditions are right. So that's my hot take on it this morning. I'd be happy to take any questions, but other than that, I don't have anything else for you guys. And you guys can get on with your Saturday morning. I'm going to play some guitar, watch some football, take a nap, and take Jackson for a long jog here in a little while. It's a beautiful day here in Austin, and I'm going to go get in the middle of it. All right, guys. Well, thank you so much for being here. And I appreciate each and every one of you guys. And thanks for keeping me company and keeping me awake. It was kind of boring, really. I mean, for me, but anyway, but if you guys wouldn't have been here, so for me to go back and forth within the comments, it made it a lot more interesting for me. So thank you so much from a selfish standpoint. But I will let you guys go, and I hope you guys have a wonderful, wonderful day. See ya.